In this video, we're going to talk about amortization together and how it works for Swiss freelancers. And we'll use Magic ID to create an example. So what is amortization? It's when you have a significant expense and you want to spread it out over several years because it better represents the value it brings to the business and the costs it generates. So let's take an example. For example, if I buy a coffee, let's say Starbucks with oat milk and everything else, which is really, really expensive during a business trip, we'll call it travel expenses. I'm not going to amortize that over several years because it doesn't make sense, especially since it was consumed that year. The coffee won't be mentioned a year from now. Now, if I buy a new MacBook Pro or something like that, it's a bit different because the computer itself I'll use for several years, so it'll be useful to me. Also, in itself, it's an asset. So for freelancers with less than $500,000 in revenue, we don't do advanced accounting, so we don't need to stress about these concepts. But it's still, an asset means it's something my business now owns. And if I sell it someday, it still has value, and we'll explore that later. There's also the aspect that if I sell it in 10 years, I won't be able to sell it for $2,500. So if I record it as an asset and aim to sell it in 10 years, I won't be able to do that. I might have paid $2,500, but $2,500 is not going to come back. So essentially, I use it or it loses value. This is a concept we are quite familiar with regarding cars, and it is often where depreciation starts for freelancers in Switzerland. So let's take an example of a car that I bought for $30,000. It's a good question, but let's do something else. The basic solution is to say, okay, I bought a car, I record it in my accounting for this year in 2024 period. But it's often complicated. So here, let's just imagine that with all the work I've done, I've made, let's say, 20,000. So a small business. We're running it here. We mark the invoice as paid. There you go. So if we look at our balance sheet for this year, we see that we have 20,000 in revenue and 32,000 in expenses, largely because of this car I bought. As a result, having a lot of expenses this year means I'll pay zero in taxes according to the estimated tax report, though obviously the social security aspect isn't accurate in this extreme case. But if next year, let's imagine I have another invoice, let's say another 20,000. All right, but this time that's for the following year. There you go, and we'll mark that as paid. If we now look at 2025, we see that we have revenues of 20,000 and consequently, there are no expenses. And as a result, we will pay more taxes. So in total, we pay zero tax in 2024 and 4,000 in 2025. This is a very simplified case, etc. But what amortization allows us to do is to say that instead of recording 30,000 for my car in the first year, let's say, let's say 10,000 the first year. So basically we're going to divide the value of the car into 3 and spread it over 3 years. So car depreciation, 1 out of 3. And we do that again, but this time for the following year. So for example, we will amortize 33% of the car again at the end of 2025. Car depreciation, 2 out of 3. Where did he go? And finally, we're going to do the same with the first time I bought this car. So now the first year, we're going to replace it. So now, in 2025, we have again 10,000, and in 2026, we have another 10,000. And so when we now look at our expenses in 2024, I have 20,000 in income and 10,000 in car expenses, so I'll pay 2,000 in taxes. In 2025, the same 2,000. Because once again, it's the 10,000 expenses for the car, and in 2026, zero, because there are no expenses yet. Spreading out what we deduct from our income, meaning our expenses, over several years, and reducing our profits to pay less tax. So that's how depreciation works. I hope it was helpful. If you have any questions, don't hesitate to ask. I'll also put an article below the video to help you. And with that, I wish you an amazing day. Goodbye. Now, if we add something else that cost us 10,000 euros, we'll just mark it as paid, but it obviously has to be in 2026. And we need to assign a value of something worth 10,000. There you go. So we said that all of this won't be taxed yet because it's amortized by the car, and basically, thanks to depreciation, we'll be able to in the first year, if we remember at the beginning, we had this case where we had 30,000 in expenses and 20,000 in income. So there were 10,000 in expenses we could have used to offset income and therefore pay less in taxes, but we didn't because we would have made a 10,000 loss that year. And with depreciation, we ended up with a total of earning 20,000, 20,000 and 10,000, so 50,000, and we would have paid less in taxes. So we would have paid about 50,000. That's 4,000 in taxes. And that's the advantage of amortizing. There you go. Just a little extra to explain that.